Thank you very much for joining us this morning at LiveMore's very own post-election mortgage market review. What have we got in store for you today? Hopefully, we've got some very, very important and interesting information that will give you an up-to-date appraisal of exactly what's going on. It's been a busy, busy year for the mortgage sector. And of course, with 50% of the world's population going to the polls this year, of course, there's a lot of political stuff going on as well, not least, of course, here in the UK. So what do we have in store for you today? We have myself, first of all. My name is Les Pick. I'm Director of Intermediary Sales here at LiveMore. I'll be talking you through a little bit of an introduction to later life if you're new to the scene. But then I'm very pleased to say that I am joined by two leading experts from the industry. So we have effectively a presentation on the economy and market update, and that comes from Ben Nabarro from Citigroup. And we've got a housing and mortgage credit review update from Alistair Bigley. And then we've got our very own Simon Webb talking about securitization and funding from a LiveMore perspective, because we've got some exciting news and it's exciting times for our particular business. And then finally, I'll do a little bit of a wrap up at the end. We anticipate this to take roughly an hour, might be slightly shorter. We'll see how we go. So in terms of the later life market, let's have a quick look at that. If you're new to it, what you need to understand is that this particular market is a growing market. And it's an emotional market too. People get very, very emotional about their properties. They get very, very emotional about mortgages. That's because quite often our most important thing that we own, our home, is also our most powerful asset. And when we talk about power, we start to think about the finances behind it. And look at the drivers behind the growth in this sector. £1.2 trillion of mortgages in this space. 2.6 trillion is the value of properties owned by the over 65s. So that's just the over 65s. Remember, later life lending starts at 50 years old for most, 55 for other products, but 50 for a lot of products. So in actual fact, that figure, if we look at the over 50s, is much, much bigger. And in actual fact, when we take a look at that over 50s market, 78% of all housing wealth owned in the UK by the over 50s. And of course, we've got issues around this. We've got socio-economic reasons why this is an issue, why this potentially could be an issue. We've got emotional reasons behind all of these changes, where the value of our properties continue to increase, even though we get to any 20-year period and say it can't possibly go again, and yet it does. And then, of course, we've got the demographics and other things that sit behind it. So we've got changing demographics, we've got increases in divorce, people living longer, all of those things that we know about. But what that does create is a very complex lending world. So we have mainstream mortgage brokers that are happy to give mortgages to people in their 30s and their 40s. We've got equity release advisors at the other end of the spectrum who have chosen to specialize in that particular subject and those particular types of products. But what the FCA is saying is that there's actually an issue here. The FCA have looked into the market and said they're not particularly pleased with what they've seen. And what they're saying is that there needs to be a more holistic view to financial planning to people with mortgages above the age of 50. And we at LiveMore are hell-bent on helping consumers, both with our products and with the relationships that we have with our very, very important distribution partners. How do you as financial advisors get the right products to the right people in the right circumstances at the right times of their lives? And this is a really, really important thing that we need to get right. I think that one of the main issues is a little bit of education around these complex matters, but equally not just education, but it's down to the sector to provide the right tools and the right assistance to be able for financial advisors to be able to give the right outcomes to their customers. Change is necessary because the FCA haven't liked what they have seen, and what they're looking for is a more holistic planning approach. I don't think there's anything wrong with being specialists. There's nothing wrong with being a specialist in most forms of life. I don't see how financial services should be any different. But what I do need to see, and what we need to see as a sector, is financial advisors working together to give their customers the best outcomes. So if your customers are better served by you specializing in equity release, that's fine. If you want to be a financial advisor who doesn't want to necessarily deal with the complexities of lending to people over the age of 50 and into retirement, that's also okay. But basically buddy up with other professionals, with IFAs, with specialists in the sectors, and make sure that the advice that your customers get and ultimately the products that they're recommended are ultimately the right ones in the long-term scheme of things. In terms of barriers to growth in the 50s and 90s, I think to 50s to 90s sector, I think accessing the borrowing capacity for older borrowers is complex, as I've already pointed out. So if you are talking to somebody about basic income, basic outgoings, and the mortgage is not going to go beyond their retirement date, there isn't necessarily too much complexity around that. However, if you've got mixed income, savings, pensions, all these different types of assets that might come into play as part of the overall addressable portfolio of assets that a customer has, then that's when it starts to get really, really complex. At the moment, and I think things can change in this field, but at the moment, sourcing platforms are a little bit too simplistic to be able to offer truly holistic affordability assessments. And brokers need to turn to multiple assessments in order to demonstrate full consideration of all options. What does that mean? It means that you're probably going into one sourcing tool to get some information, into another sourcing tool to get other information. You're using various different forms of calculators from different places in order to try and get to the ultimate outcome, which is your customers having the best possible product. There is no go-to platform at the moment for later life. There is for mainstream mortgages, there is for equity release, but there isn't necessarily for one for later life in the holistic sense. We have done our best to help customers and obviously financial advisors as well. The LiveMore Mortgage Matcher takes away an awful lot of the complexity. We have over 300 different product variants on the platform, and what this enables a financial advisor to do is to jump on, pop all of the various different assets and income details that somebody might have, both pre and post retirement. That will then give you the 4 different types of product sets. We're the only lender in the market space to offer all 4 types of product sets to later life customers. So we have capital and interest mortgages, we have interest only mortgages, we have REO mortgages, retirement interest only, and we also have equity release. This will give you the PDF that you need to put on your file to prove that you've had that in-depth conversation with your customer, and also the types of outcomes that might be available in the market space. Lots of financial advisors are choosing to use this as their go-to tool to help them navigate the complexities that exist in later life lending. So we're doing our best here at LiveMore. We are only a small lender, but we're a growing lender. There's big aspirations, and we'll cover off some of that later in the presentation. And of course, we've got Simon Webb to talk you through our most recent securitization. But without any further ado, I'll hand you over to Benjamin Navarro. He's Chief UK Economist. Ben, I'll hand over to you. The presentation that we saw last week was very, very informative and interesting. So I'll hand over to you. And if you need help with the slides, just tell me when and I'll turn them over for you.
That's very kind, and thank you for LiveMore for the invitation to speak to you all this morning, and obviously thank you for attending as well. Look, I mean, it's easy to be gloomy about the UK economy. As you will see or will have seen with most press reporting, things are getting better, and I think there are certainly some causes for optimism, particularly when you think we're coming out of this extraordinary period over the last few years of supply volatility, where we've been buffeted from pillar to post by the COVID pandemic, the war in Ukraine. But really what I want to talk through today is 3 core ideas which I hope will be useful in terms of framing the macroeconomic outlook for the UK. The first is I want to talk about this concept of a bumpy takeoff, because as I say, I think things are starting to get better. But where we see potential difficulties from here, and we think there are some, is increasingly moving from what economists describe as the supply side of the economy, so capacity in effect, more to demand, and that's spending, associated consumer momentum, where contrary to, I think, lots of the public commentary, I think there are probably still a few challenges ahead. I want to talk then a little bit about inflation and rates, where we think there are causes for optimism. Obviously, the UK has suffered from very, very high consumer price growth in recent years. We think we're coming to the end of that period, and we're relatively confident that price growth will fall back all the way to the MPC's target in the medium term, and I want to explain why. And with that, we think there's the potential for rates to come down perhaps a little bit more quickly than the market is expecting over the next 18 months. And then last, but certainly not least, I want to talk a little bit about Labour's potential economic policy choices. Those, I should say, will probably be quite difficult, but we also see there some causes for structural and supply side optimism, particularly as we look into the longer term, where we think some of Labour's agenda actually holds reasonable promise. So with that, Les, if it's possible to move to the next slide. Or the first slide, rather. Next one. Brilliant. So just to kick off, it's important to see the weakness, or how much pain the UK has already gone through macroeconomically over the last few years. Most economies, if you look at the euro area, for example, has suffered a permanent loss as a result of the pandemic. So there you can see real GDP in the euro area is 4.2% short of its pre-pandemic trajectory. US, it's about 3%. In the UK, that shortfall is between 6.5% to 7%. So this has been a very large loss compared to where we might have plausibly expected the UK economy to end up on the eve or through the turn of 2019-20. In terms of what stands behind that, and turning to the next slide, Les, what's important to keep in mind is that's occurred, or that weakness in activity has occurred, even as, of course, the labour market has been very, very tight indeed. And that reflects the fact that where the UK has really suffered is on the capacity side, on what economists call the supply side of the economy. Now, some of those effects are probably going to be permanent. We do think, for example, that things like the increase in inactivity is probably going to be with us for some years. But there are some areas where we can be a bit more optimistic. So, for example, we do know over the last few years that very rapid reconfiguration associated with both the pandemic and COVID, that has weighed on capacity, and those effects should now be gradually beginning to fade. But one particular area I want to focus in on is what's shown here in these two charts, which is to do with the relative price of labour. Now, this may sound very esoteric, but what's important to keep in mind here is just as higher energy prices have obviously weighed on real incomes, they've also created quite a large macroeconomic incentive to substitute out of capital-based production and into labour-based production. So just to give a sense, things like consumer services have been relatively cheap compared to consumer goods. Equally for firms themselves, there's been this wish to try and use labour as much as possible, and that has weighed on productivity and boosted labour demand. Now, what's important now is this generational terms of trade shock that the UK experienced 2 years ago. That hasn't just faded, but is actually reversed. And what that means is this incentive, this supply destructive incentive, is whipsawing around quite extensively. So in terms of where that leaves us today, just as we've really suffered from an investment and productivity perspective over the last few years, as capital, that kind of investment side of the economy has really been suffering, what we're now seeing is a reversal of that process. That should be very good news in terms of boosting investment and boosting labour productivity growth in the near term, but it also poses the question of whether demand, so spending in the economy, can keep pace. And if I could go to the next slide, Les. On that particular point, there are still some significant questions. And the main question here is really about the impact of economic policy. So on the left-hand side, you can see the cumulative impact of rate hikes on the UK, on GDP, real GDP in effect, from the onset of the pandemic. Obviously, it was boosted activity, all else equal initially, and has been weighing as rate hikes have fed through. But what's important here is even on a historical calibration, so this is based on 1970 to 2019, we're probably only about halfway through the process. And in fact, we think, if anything, transmission has been a bit slower in this cycle, reflecting changes in household balance sheets and shifts towards services-based production. So if anything, we're probably more like 30% through, and that will continue to weigh on demand. And then on the right-hand side, what you can see is the impact of discretionary fiscal policy on growth since 2020. And that has been very supportive over the last few years, as you might expect. But we're now starting to move into a period where, just as we sort of remove some of that COVID and energy support, we're starting to see a meaningful growth headwind begin to emerge. So in effect, structurally, the UK is getting to a better place, which is, as I say, very, very welcome. But just by virtue of the policy position that we begin with, it's not obvious that demand and spending will be able to keep up. Now, turning to the next slide, what does that mean? Sorry, next slide again, Les, if we can. Next one again. And one more. Apologies. Brilliant. So in terms of what that might mean, well, the key risk to keep in mind is we may be surprised in terms of seeing the labour market continue to loosen somewhat. We've already seen some evidence of that already. That's broadly been welcome in the sense that it's what the Bank of England has been aiming for in terms of taking out excess demand. But just as we see the supply side continue to recover and spending fall short, perhaps there's a risk that even with volumes growth somewhat positive, so we're not falling into recession, we do see unemployment continue in its upward trend that we've seen so far. So we're looking for unemployment to end the year at around about 5% or so and go up through 2025, up to about 5.5% over that period. That's consistent, we think, with growth of around 1% or so in annualized terms over the next few quarters. So you sort of have this modest volumes growth, but not quite enough to absorb that excess supply, and that's what's or additional supply, and that's what's fundamentally causing the problem. So improving supply, growth not falling off a cliff, but not particularly good, and labour market slack gradually increasing. With that all said, I think it's worth turning therefore to the inflation picture. So just Les, over to the next slide, if we may. Thank you very much. Yeah. So just turning on the inflation picture, and sorry, I think that was just the previous slide. Yeah. So there are two big debates in UK inflation, or there have been two big debates over recent years. Obviously, we saw inflation climb to double digits through the end of 2022. It's then been falling back gradually. And the debate that economists have been having is, does this reflect a fundamental change in the way price and domestic wage setting is behaving? In which case we plausibly have quite a lengthy challenge on our hands of higher rates, higher unemployment to gradually bring the process back to a contained or target consistent level or basis? Or is what we've seen actually a very large supply shock, some second round effects from that very large shock, but ultimately this is sort of being transmitted through, it's a level effect, in other words, and over time we'd expect inflation to converge back to normal. And normal here is perhaps you could think of as roughly an average of pre and post GFC periods. Now, our reading of the data is generally much more consistent with the latter effect than with the former. And what I mean by that is, just because economists, ourselves included, have got things wrong as far as the overall trajectory of inflation and its some stickiness over the last 12 months, that doesn't necessarily satisfy the burden of actually proving that things have fundamentally changed in the economy at large. There's a middle ground that just says the models you were using were not particularly appropriate to economic behavior when the shocks are quite this large. And when we work through the evidence, we find more and more evidence of that sort of effect. So just to explain, the way we see it in terms of this shift, and to be clear, this is our view. Other people quite reasonably take a different perspective, or at least a different view of the risks, is we've had very large shocks to food inflation and energy. Those, of course, affect cost structures for firms in the domestic sector, and particularly the domestic services sector. That adds to services inflation. It also impacts wage demands as people try and protect real incomes. But gradually, we've seen the transmission process from upstream to downstream costs behaving in a broadly conventional way in terms of what we would have expected from a 2000 to 2019 period, in a context where inflation was well anchored. And if you actually look through the detail, you see more and more evidence now that as those second round effects are fading, in fact, sequential price growth is coming a long way back to target. So just to provide a little bit of color on that, if you look at the bottom right-hand side chart here, for example, this decomposes services inflation into those elements that are more services intensive and those that are more labor intensive, shown in the light and dark blue respectively. What you can see is the vast majority, the very large increase in services inflation that we've seen so far has really been focused in those areas that use energy and to some extent food particularly intensively. As those price shocks have worked through, you've actually seen growth in those areas come back quite sharply. And, in terms of the outlook from here, our thinking is that services inflation will probably be somewhat sticky over the summer as firms try and pass on, in particular, the impact of the higher national living wage. But thereafter, we think that price growth will probably normalise more fully. And that should give policymakers more confidence in terms of potentially beginning to dial back the highly restrictive policy stance. One additional point we'd make here is in terms of pass-through, so in terms of firms' ability to pass on cost increases into final prices, what we've seen over the last 6 months or so is quite a sharp retrenchment in terms of firms' ability to pass on. And what that means is increasingly we're seeing firms, which are still in quite a weak margin position, shifting from passing on price increases in terms of cost challenges to actually cutting back on staff. And that's something that, again, adds to that unemployment story I was mentioning previously, but also increases the potential that the Bank of England is ultimately forced to cut rates back quite quickly. So in terms of where that leaves the headline rates forecast for us, we're looking for rates to probably fall for the first time in August. I think that could well be shifted to September. I think there's real uncertainty about that. But in terms of where rates are going through 2025, that combination of full disinflation, easing labour market, and accumulating fiscal headwinds, that's an environment where I think we're probably looking at the Bank of England cutting on a back-to-back basis and probably to a lower level than markets currently anticipate. So if I could turn to the last section then, which is just a few brief comments on labour itself. The chart I showed you previously of that fiscal growth impulse across years, that's based on current fiscal plans as set out by the previous government. In terms of what Labour may choose to do, I mean, it's no secret the difficulty of their fiscal inheritance here. There is very, very limited, and I would actually make the argument probably negative fiscal headroom in terms of their sort of ability to dial up support. The question then is politically, does it make sense to front load or the pain you might need to create space or to backload it? And our sense is that Labour's probably more likely to front load some of these difficult decisions. That's partly to do with a historical pattern, which politically chancellors have generally preferred to front load pain, backload gain, which you can see in this chart, for example, which shows net tax increases for the first fiscal event after a decisive election result. Those are shown in red compared to all of the rest in blue. But it also reflects the fact that probably the best way Labour can begin to dial back or generate fiscal headroom will be by trying to get interest rates down themselves. So every 1 percentage point on UK rates gives you about 20 billion in fiscal headroom. And if Labour are going to get through the next 5 years without either borrowing significantly more, significantly increasing taxes or cutting back on spending, then really rates are going to be the only way we think they can navigate through. And that, again, adds to the incentive to front load. So that we think is potentially an additional headwind for the next 12 months. What I would say is that potentially slightly more negative story is juxtaposed with things that from a structural perspective, we think we can take some comfort from. So one example, of course, the relationship with the European Union. There we think Labour's plans plausibly imply a 2% cumulative improvement in the level of productivity growth over the next 10 to 15 years, simply by making that relationship work better. And we would also say that when we look at things like planning reform, certain areas to or certain plans around skills, regional investment. These are things that, if executed even to a modest degree, but executed in a relatively sensible way, all could add to growth on a cumulative basis. So again, I think it's worth being a little bit careful about thinking that Labour's going to boost growth in the very near term, but over a 5-year period, we think there are grounds to perhaps be a little bit more optimistic about the trend growth position in the UK, perhaps compared to where we've been in recent years. And with that, I should stop and pass back.
Ben, thank you so much for that. That was really, really informative. I will do a little summary at the end of this, but yeah, really, really, really informative. Thank you ever so much. And it is interesting to just note, that cautious optimism, and also your view. Particularly, I know that a lot of our viewers will be interested in your view on the potential drop that we've been looking and hoping for in that Bank of England base rate for most of this year. So thank you very much for that. And on to Alistair Bigley next. So Standard & Poor's, S&P Global Rating Sector Lead. Again, I know that this is more sort of property and housing related rather than markets related. So again, I'm sure this will be very, very interesting to all of our financial advisor listeners this morning. So without further ado, over to you, Alistair.
Yeah, thank you, Les. Yeah, just to introduce myself, I'm Alistair Bigley. I work for S&P, so I guess you may be familiar with the S&P name, but specifically, just so you know where I sit within the ratings business. So what we do, what the team I work in does, is offer third-party opinions on debt products that are ultimately backed by mortgage payments and by property. So that's I guess that's the reason I've been asked to speak at this event. So what I'm going to do today is just recap where we are to start with, just in terms of the market, where house prices are, what's happening in the credit environment in terms of delinquencies and defaults, and then I'll move on to some forward-looking elements of what the change in government may mean to the overall housing and mortgage market. So, and the next slide, please, Les. And the next one, yeah. Yeah, so what you've got on screen now is the 4 pillars that we view as mainly influencing consumer credit in any given country. And yeah, not to cover the ground that Ben's already covered, but probably important just to dwell on a couple. I guess unless you've been living on a different planet, you'll know what's happened in the last 2 to 3 years in relation to rates and inflation. But our overall view in the next 1 year to 3 years is similar to the one that Ben explained. I think there are differences, but I think overall, just looking at rates, yeah, we do expect rate cuts this year. I think the implication is of 3 this year. So overall, moving down rate environment over the next 3 years, but not, I think importantly, not back to where we came from. So it will be a slightly higher interest rate environment than we used to over the last decade or so. Again, just in terms of growth, yes, growth, but not particularly strong. Inflation will moderate back somewhere towards target, and unemployment, yeah, there will be a softening, is our view, but that softening is probably not significant in the overall context. And just to put some of these numbers in historical context, just in terms of unemployment, for any of you around in the market in the wake of the global financial crisis, UK unemployment rose to about 8%. But obviously that significant contraction met with a very significant policy response in terms of base rate going well under 1%. So the thing to bear in mind is all these stresses and all these scenarios that play out through time, that they're all somewhat different. But that's our overall view, and I don't think in the terms of material there's a huge difference from what Ben explained. So overall, I think this points to for mortgage lenders, I mean, certainly compared to the last 2 to 3 years, this is a more favourable environment, and I think one that would, I guess, cause for optimism, certainly compared to any point in the last 2 years when rates have been increasing and volatile, etc. Market rates have been particularly volatile compared to base rate as well. So yeah, moving on to the next slide. So this would talk about house prices because everybody loves to talk about house prices. I think you can obviously pick your headlines with house prices, and there have been some level of nominal declines over the last 2 to 3 years, but it has been patchy. It's been regional. It's not been a sustained trend either. So where we are now is a position where we've had, you know, more or less negligible nominal declines, which is important because that means that what you don't have is a number of borrowers or a large number of borrowers who find themselves in low or negative equity, which when it comes through to how this might play out, what you don't have in that situation is any material number of forced sellers. So that's the first thing to bear in mind. The other thing is just in terms of where we've not seen nominal declines, but where we have seen the declines where they have come from, obviously with, you know, more or less flat house prices and inflation getting towards double digits for a sustained period. What you have had is significant real-term price decline, and that's what the graph on the right-hand side of the page shows. So that's the current position. I think the overall view is obviously we're now expecting wage growth to increase, and that's what you have on the left-hand side of the chart. Clearly, there's some level of uncertainty as to how strong that wage growth may be for some of the factors that Ben alluded to in his presentation. But I guess the hope for mortgage lenders, for mortgage lending, is that this demand is created by a number of borrowers suddenly feeling that relative to income, that house prices suddenly look comparatively cheap. Well, our overall prediction just for house prices is one for the next 2 to 3 years is one of flat to low single-digit growth. So that's something to bear in mind when we're talking about how the market might evolve, because obviously the mortgage market is somewhat driven by house price growth, but we'll come on to that in a slide's time. Let's move on to the next slide. So what you have on screen here is on the left-hand side. This is our data. So this just shows the transactions that we offer opinions on, that we rate. This does broadly reconcile to the wider mortgage market. So if you look at the Bank of England data or UK finance data, the trend, what I'm about to explain, is broadly comparable. So the thing to focus on is the bottom lines on that graph. So that is the yellow and the red line at the bottom, which are kind of barely registering about the 1% rate. So this is number of borrowers who are 90 days past due on their mortgage payment. So what this tells you, what those yellow and red lines are, so this is what we call the systemically important part of the mortgage market. So this is either prime UK buy-to-let or prime owner-occupied mortgages originated by the high street lenders. And this, in context, just because this graph is not balance weighted, so this represents about 1.6, 1.7 trillion of collateral. Now that's a very good story, because what we've seen is that the fixed rate reset risk hasn't really materialized, and whilst it's certainly going to be pain for some borrowers in the future, we don't think this is going to be a significant risk for the overall systemic health of the mortgage market. Now, the other thing to focus on this graph is what often referred to as a hockey stick shaped line on the top two lines at the top. So this shows legacy collateral. Legacy collateral, for context, means collateral that was originated in the lead up to the global financial crisis. So what you can see, this collateral has performed particularly poorly in the last 2 years in the rate environment that we've seen. So this is about 30 billion of collateral. So overall, systemically, arguably not important, although the reason it is important is because ultimately this performance is what influences various people within mortgage markets and regulators. So what we have is very good performance based on regulation that has been introduced in approximately 2014, and very bad performance that was for legacy collateral. So it's an open question, really. What we have now is a policy position that seems to have worked, has insulated the UK from a relatively significant shock. So it's an open question to what degree the regulator may or may not relax some of this, some of that regulation that came in 2014. So we'll come on to maybe speculate in the next slide. What you've got on the right-hand side is UK mortgage possessions, which, again, just putting this in context, and it's back to that forced seller point. Yes, you've seen a significant increase in absolute terms in repossessions, but this level number in the context of a mortgage market that's at just under 1.7 trillion is really, really insignificant. Yeah, it's backward looking, and the argument this will increase, but we don't think it's going to increase to a level that is going to be in any way an issue for in terms of the systemic health of the UK mortgage market. So coming on to the next slide. Yeah, so I think just in terms of where we are, obviously changing government, I think the things we would highlight is there's obviously a house building target. The house building target approximates at 300,000 units a year for the next 5 years. So where we are at the minute, we're averaging about 170,000 units. So obviously a significant shortfall based on where we are at the minute. In terms of the overall context of the market, in terms of housing waiting lists, there's over 1 million people on housing waiting lists, and we have a growing population. So, I mean, our view, whilst this is clearly an ambitious target, the question that some people have posed is building this many houses likely to put any sort of downward pressure on existing housing stock or house prices? Our view is probably not, just given this is a target over 5 years and given some of the supply side, the demand side phenomenon we see. So we don't think the target is going to move the market in that respect. I think the other thing we don't really know at the minute is what the actual desired outcome is here, as in, we have a target of building houses. We probably can guess that there's going to be some level of affordable social housing within that. To what degree, who's going to be advantaged by this, whether they're targeting first-time buyers, whether it's other demographics within the market. That element of it is still a little bit unclear. So I think for now, without wanting to sound like we're sitting on the fence too much, we're in sort of wait and see mode in terms of how it might play out. But I think the final point on the sub bullets there is a big difference between building houses and financing houses, because what we've seen, the way the mortgage market has evolved over the last 10 years or so, ever since the impact of the mortgage market review was put in, is a lot of product evolution has been, and a lot of government policy has been driven towards creating solutions that fall out of that policy. So it's things like shared ownership, right to buy, help to buy. All these sorts of policies have been the response to that, trying to create opportunities for people to get on the housing ladder. So we don't know how ultimately whether there needs to be some level of relaxation or some change in policy that's going to allow or open up mortgage purchasing for some of the demographics that are currently finding it hard to meet affordability levels. So that sort of thing. So that is an open question as to whether this target can be created within its current regulatory framework. I mean, some of the things just moving away from that target, I think some of the obvious potential consequences of changing government are mortgage products that are explicitly born out of existing government policy, and there is a possibility that some of these policies may no longer be as fashionable as they were in the previous administration. Things like the obvious ones we would highlight there are things like right to buy, shared ownership. These are policies that are a function of previous government policy. They may persist. Shared ownership is technically owned by Homes England, which is is a government agency, but is slightly separated from government, being not part of the civil service or anything like that. So an open question on whether some of these products still exist or whether something's going to replace them. I think the other thing that may come back on the agenda having abruptly left it. Last year was the whole the greening of the housing stock. Exactly how that happens, I guess, to be determined. The previous policy was effectively, I mean, obviously some level of assistance with heat pumps and things like that at the owner occupied level, but a lot of previous policy was more using the stick method rather than carrot method for landlords, and requiring EPC levels of certain grades for properties to be let out over time. So I guess that's the open question as to whether we see that returning, or in what form, what kind of products will be advantaged by that is something I think to keep an eye on. I think just in terms of the wider environment that we see, obviously products like bridging lending, all this sort of thing, if we are going to build that many houses, bridging, for smaller scale developments is going to be, and development finance are going to be the products that may see a significant shot in the arm. I think the other thing is different uses for existing products. So second charges would be the one we'd highlight, we've got on screen. Second charges, they have multiple uses. A lot of it is for debt consolidation, and a lot of that debt consolidation effectively requires equity, and that equity has previously come from house price growth. If we don't see house price growth, then there's certainly a possibility that we may see stunted growth in the second charge market. But there are other policies that may boost demand there. I think VAT on school fees, obviously, for some people who find themselves in that position, don't want to move their children out of school, don't really have the money to pay the VAT, then using their property as some kind of cash machine to pay that extra burden is going to come into play. So I think that there's still some detail that we need to see, and it's going to be interesting to see how this impacts policy and overall whether this is a game changer or not. I think it'll be clearer in the next 3 to 6 months. So yeah, moving on to, I guess, some of the policies that we probably would have expected to see, irrespective of government. I think buy-to-let, I mean, our view is, yeah, the supply and demand. Obviously, there's been a constant, people have constantly called the end of the buy-to-let market at various stages over the last 6-7 years, whether it's changing tax rules, increased regulation, all these sorts of things. But the supply and demand dynamics are still, in our view, there. But what it does point to is more leverage. For landlords want leverage, and that points to higher yielding property, and higher yielding property points to more esoteric collateral, such as mixed use, more multi-unit freehold blocks, all that sort of thing. Yeah, in terms of products, I've covered second charges already. I think the interesting one is, obviously, particularly for the audience here, is lifetime mortgages, reverse mortgages. So our view is house prices broadly flat. Or the view, to recap, is that rates certainly not falling back to where they came from. That makes getting the advance you want, if you're going to go down the equity release route, a little bit more challenging, as in the advance amount you're going to get as a customer for equity release may not be as high it would have been when rates were lower, and a more positive view of house prices. So that points towards products like retirement interest only, where, because you're servicing the interest, obviously, that there may be a bigger day one equity extraction possible than would be the case under equity release. And I think just very, very briefly, it was Basel 3.1. This is a very technical point of banking regulation, but I think that the key takeaway here is that some products, buy-to-let being one of them, is going to be, or complex buy-to-let being one of them, is going to be less appealing for banks to originate. It's going to push this into the non-banking sector. That's something to look out for. And I think the last point we're going to highlight is changes in demographics. So we have two things going on. We have a significant interest-only maturity from elderly borrowers who took out an interest-only loan in 2005, 6, 7, that sort of era, who now have a bullet payment. That is a significant significant niche, running into billions of borrowers in terms of pound value of which might form the mortgage market. And the other thing we're seeing is I guess demographics changing. I think this is the first time in history where what we have is an affluent aging population. So private pensions, and in the past we saw very binary housing choices in terms of you lived in your house, and if you weren't capable of doing that, then you'd move into long-term care. We're seeing that middle ground of assisted living, but owning your house within a complex. These are the sorts of inquiries we're fielding because people have the money and they want to spend the money, enjoying their life, whilst they still have the physical ability to do so. And these are the very interesting requests we're getting in a minute that are completely novel in any sort of historical context. So I think that's my presentation overall. So I think overall, to summarize, I think cautious optimism is maybe the key takeaway, and for most mortgage lenders, it's probably a better place to be than they have been in the last 18 months, 2 years. Far easier to manage a business, and some of the fundamentals that drive demand are more favourable than they have been.
Lovely. Thank you ever so much, Alistair. I mean, for me personally, I was making a few notes as we went through there, just to bring some of that technical stuff into sort of more layman terms. Well, this is what I took away from it. And guys, by all means, challenge me if I've got the wrong end of the stick. But for some of our viewers, I mean, the air of cautious optimism, I took that from both presentations. Savers have been looked after, of course, very, very well with these higher interest rates. But it looks like those interest rates will start to come down now, helping mortgage borrowers instead of investors. Inflation appears to be under control. Of course, we knew that already. We see that in the press every day, but knowing the reasons why, I think is very, very useful. GDP has suffered, but there's still some tough times to come, but hopefully we can see light at the end of the tunnel. Everything that we're seeing and experiencing is in line, it would appear, to the educated people, economists and stuff. Everything that we're seeing appears to be in line, so there's no major shocks there. And fiscal policy and tightening has been painful, but front-loaded pain for long-term gain. So they were the things that I took away from Ben's presentation. Alistair, yours was very, very important for those of us that work in and around property and mortgages. House prices have remained stubbornly strong despite the tough times and that payment shock. So there's been a lot of tough times over the last few years that we all know about, but an Englishman's castle should I say, home remains a castle, should I say. So we still value our properties, and we still love to own property in this country. British people continue to see the long-term value in home ownership, and of course that does create that supply and demand issue. And whilst the market is subdued, there are many reasons to be optimistic. And if we look at the commitment from the Labour government to what they're going to do with building those additional houses, effectively doubling what the current run rate of house building, I mean, that's quite an interesting thing. It's a great thing to say. It's important to note that actually, from Alistair's presentation, that's not going to necessarily adversely affect the value of current stocks. But what I would say is, just from my own personal experiences, I'm not entirely sure where we're going to get the builders from. They're already charging an awful lot amount per day on a basic supply and demand basis. So it'll be interesting to see how many millennials we can drag out of coffee shops and call centers and get them onto building sites as quickly as possible, I suggest. So that will be interesting to see how that pans out. New fiscal policy seems to offer support to mortgage demand. HPI will remain steady in single digits. And Alistair suggested that today may not be the best time to look at, I think, what he called reverse mortgages, but effectively what we know as lifetime mortgages, but then actually RIOs and interest only, certainly in the short term, until we know exactly what the long-term prognosis is, might be a good thing to consider for some of the customers. So that was my taking from those. I don't know if I've missed anything particularly vital or if you challenge any of the things I've just said, but I'd suggest now, speak now or forever hold your peace. And we'll move on to Simon Webb, who's Managing Director of Finance and Capital Markets here at LiveMore. I did promise you about an hour, so you'll be very glad to know that Simon's only got one slide to talk us through this morning.
Yeah, thanks, Les, and thanks, Ben and Alistair, for your time this morning. As Les mentioned, I'm Managing Director of Finance and Capital Markets at LiveMore, and very much want to take the discussion back to LiveMore now, and give a brief overview of our funding activities, which are very much the business as a business in the 50 to 90 plus segment of the market, very much developing innovative funding solutions to support our innovative product range in the market. And because of our target market and our product suite, we are really pioneering a bit in the funding space, with quite a few firsts in the market to date. The first mortgage lender in the UK to establish a wholesale funding line for the retirement only product, which is, as you'll know, is a product that was has only been around or defined by the FCA for 5 or 6 years or so. And also, we recently completed our first securitization, our inaugural securitization, which our understanding is the first securitization in the UK market to include retirement only product as well. So lots of firsts for us as a funding business. We have introduced in our time, we've introduced 2 funding lines, from large banks, one of those being a large UK bank, and the other a global bank, and that being Citi, and thanks to Ben and the team for supporting us as a business. The securitization itself, which we completed in June of this year, I won't go into the details of the securitization, but it was a deal that was publicly rated by S&P and Moody's, so 2 of the larger rating agencies in the market. It was well received by investors, with circa 15 investors participating across the various bonds that were offered. And it was a very strong showing for a first-time issuer, also for an issuer, or a transaction which included RIOs for the first time as well. So in summary, where that leaves us as a business is a well-funded business with diversified funding lines and sources of capital that enable us to support the growth that we are seeing, and to enable us to provide the products that your customers are looking for. We continue to work on our funding. Our funding lines to date are able to fund or support the various payment offerings that we have, from RIO, standard mortgage, and our equity release product. And we continue to work with our funders, to continue to innovate our funding or our product suite. The next cab off the rank for us is our part mortgage, which we see as being very useful to some of our customers. And we will continue to innovate, and we're really paving the way there, for further product innovation to our target market. And with that, Les, I'll pass back to you. Thank you.
Thank you very much, Simon. Yeah, it's been an exciting year to join this business, I have to say. And just for the last little wrap up from me, just a little bit of, I guess, those of you who know me, I'm a kind of a fan of what we do, and what you do, having been a financial advisor myself for some 16, 17 years. And I think just to make it real in terms of what we do. So what does solution-based approach mean? What does, we are a lender that tries to say yes, all right? We look for our niches, of course, but we try to say yes. But we don't just try to say yes from a commercial aspect. Of course, commerciality is very, very important to any business. But Leon Diamond, who set this business, came to the UK and realized that there was a section of the market that was underserved. The over 50s, the safest people, the people with the most equity, the people with the best credit scores, were not able to go and borrow money against their properties. They were not able to get mortgages that he felt that it was right that they should get. So that was the starting of the kind of formation of the business, the ethos of the business. So whether it be income type or product type or property type, the whole ethos of our business is to try and say yes to more customers more often. And what does that mean to you? Well, it means to you that you can earn more money. We hear far too often that, a financial advisor will say to one of my team or to one of the underwriters, do you know what? It's crazy. I was the third advisor, the fourth advisor this particular customer spoke to. I know how you work. I can't understand how other people don't know how you work. So I guess as a sales team and a sales director for this business, my job is to spread the word as widely as possible about exactly how we work and why how we work is important to you. And more importantly, really, the reason we all get out of bed in the morning is to help customers. And of course, like I said earlier, these things become very, very emotional. I do believe that my next job needs to be, if ever I have a next job, needs to be in either pensions, investments, or protection, because the emotion that's involved around mortgages is something we all live and feel and breathe every single day. And it can be stressful. We know it's stressful for you. It's stressful for your customers. And of course, at times we feel that stress too, as we try to deliver the best possible service and the best possible products in the most amount of different types of ways possible. In terms of what's next, Simon's already covered off some stuff, but look, we've gone out to our customers, that's you and consumers, for feedback about how we work and what we should do next. We've completely given a total overhaul to our policy, our lending policy this year. It's been ongoing since I joined here, so over 6 months ago. So there's a complete lending policy review that's taken place, and we'll start to see the outputs of that soon. Part and part coming, expansion to property types, income types, and all of those things, helping you to say yes to more customers, and everybody do well out of it. Customers getting the products that they need, you getting an additional income stream that you might otherwise not have had, because like some brokers are just letting those pound coins slip straight through their fingers. And of course, from us as a business, we have the advantage of our targets are pretty big for the year, so we have that ability to grow the business in the trajectory that we would like. So that's basically it from us today. Sorry for the slight delay at the start. However, delivered in an hour as promised, including all of our conclusions. Please, if you do have any questions, email the email address here. Get your camera out. If you've got a phone, just make a note of it. If you've got a pen. If you've got any questions at all about anything that you've seen this morning, please do get in touch. We'd be delighted to help. And of course, my sales team as well. If you've got any questions for them and you've got their contact details, get onto them. Alternatively, jump onto our website where you'll find your local BDM on there. But all that remains today is to say thank you very much to our guest speakers and also to you for your presence. Thanks ever so much.